industry business designer.
India's financial sector has seen extraordinary growth in terms of depth and spread, while banking assets have bolstered. Though the growth of stressed assets has not relented. The institution engaged in running, managing, and regulating these three subsectors are seeking technology support to cope up with the magnitude of the business and transactions.
There is also a shift in the mode of transaction. Majority of transactions in India earlier were paid in cash, but with the growing penetration of computers and smartphones and increasing access to the internet, Indians are adopting digital channels for their financial transactions. Digital payments have not only been made possible by banks, but also by several digital wallet-based payment companies. These have been enabled by the evolution of several technologies, which are together categorized as financial technologies or fintech, and they are specially focused on the financial services sector. The scope of fintech is now spreading fast to other applications beyond just payments.
Banking sector has made an impressive foray in assets built up, which has gone up to 1.4 lakhs billion rupees in 2017 from 95,000 billion rupees in 2020, but was dented by non-performing assets, which increased in the last 5 years from 1,900 billion rupees to 7,900 billion rupees. Given the risk management technologies, the restructuring of the portfolio companies, as well as the technological support, how Indian banks will cope with the challenges is a matter of interest. In addition, sweeping changes in technology has also brought startup companies to compete in the banking market. The competition between the banks and financial technology companies, domestic and global, has become insurmountable.
These financial technology companies are venturing into lending and soon will be entering other areas that were previously the bastion of banks. Banks may have to exploit artificial intelligence and analytics to derive actionable business insights from the mountains of data they have captured over the years. These vast amounts of data will also help them to increase transaction efficiency by reducing friction.
We are extremely fortunate to have amongst us some renowned professionals from the industry as panelists for the discussion. May I now request all the dignitaries to take their seats. We are extremely proud to have Shri S.S.K. Pradhan today with us. Shri Pradhan is the General Manager at Reserve Bank of India. He has been associated with RBI for the last 17 years and is currently in charge of the Department of Non-Banking Supervision, responsible for on-site and off-site supervision of around 2,400 NBFCs. During his association with RBI, he has consistently risen through the ranks from manager to assistant general manager to deputy general manager and finally to the general manager of RBI. He has worked on various important projects, ranging from being in charge of accounting unit of the balancing management department to being in charge of the regional office of informational technology department, handling staff of about 2,500. The Department of Cooperative Bank Division, where he was responsible for the supervision of more than 500 urban cooperative banks. He accomplished his MBA in Financial and Security Analysis from the University of Florida, specializing in securitization and derivatives, and is also a certified professional in the financial risk management, treasury investment, and trade finance. He has received appreciation from the top management of the bank for effectively organizing several board meetings of RBI for 4 years, as well as special meeting of governors of Central Bank of 40 different countries of the world, which included top businessmen, scientists, and economists of India. He was also awarded Golden Jubilee Scholarship from RBI for higher studies abroad. In his leisure time, he is a marathon runner and a horse rider. He will also be moderating this session.
Next, we have Dr. Manoranjan Sharma, General Manager, Chief Economist, and Chief Learning Officer at Canara. Dr. Sharma has wide and diversified work experience, including evaluating the performance of branches and circles, formulating, executing, and streamlining economic research policies and programs relating to the banking sector. He has first-class bachelor's and master's degree in economics, first-class postgraduate diploma in business management, and a PhD. His book, Global Economic Meltdown, and 5 other edited books have been widely acclaimed globally. His views have been cited in the Parliament, the Associated Press, New York, Wall Street Journal, and the Economic Times.
We would also like to welcome Shri Nuti Chakravarty. He has 27 years of rich exposure in various fields of retail and corporate banking and is currently serving as the Executive Vice President, Business Banking Head of North Region at Axis Bank. He holds an MBA degree in Banking and Finance and a PG Diploma in Industry Relations and Personnel Management, and comes with a multitude of expertise in the fields of strategy relationship management, credit risk management, and business development.
Next, we would like to introduce Sri Biswanath Sengupta. He has more than 30 years of experience in leading global delivery organizations and execution of large ICT projects. He has worked with renowned organizations such as Wipro Technologies, Tata Steel, Siemens Business Services, to name a few. He has managed customers like National Savings Bank, Commerce Bank Germany, Government of Germany, Government of South Africa, and many more. He is co-founder of an IIT Delhi fintech startup and advisor to many fintech and payments organizations. He is also instrumental in building next-gen financial solutions on blockchain. His USP lies in building fintech solutions and payments, financial inclusions, Aadhaar Pay, UPI card, and mobile payments. He also led the building of the largest identity system in the world, UIDAI. This is the largest social transformation across the globe with vision and narrative.
Now we would also like to introduce Shri Samir Mehta. He is the Chief Business Officer at Fincorp. He served as the Head of Commercial Lending in Bajaj Finance Limited. He has over 17 years of experience and added responsibilities in sales management, product management, and marketing communication. He is an expert in setting up and managing SMEs, MMEs, asset businesses. He joined Bajaj Finance from August Commercial Banking, where he served as Program Head of Business Lending. Prior to August, he worked at ICICI Bank and ING Life Insurance. He is an engineering graduate from National Institute of Technology, Kurukshetra, and holds an MBA degree from IIM Lucknow.
Last but not the least, we would like to introduce Dr. Ahindra Chakrabarti. He has been a professor at Great Lakes for the past 5 years. Prior to this, he was director at International Management Institute, Calcutta. He has also taught at Management Development Institute for almost 2 decades. Dr. Chakravarty holds PhD from the University of Pradhan. He has a number of research publications to his credit. His area of expertise is financial and management accounting, infrastructure finance with focus on energy sector. He has handled consulting assignments for the Department for International Development, DFID, European Commission, International Labour Organization, and World Bank.
Welcome you all to the Financial Services Conclave Sapience 2018. We now request Shri Pradhan to begin the panel discussion.
Thank you. Distinguished professionals and faculty members, panelists, and students. Being from the regulator, and the topic here is banking sector and its future, technology to develop. Let us thank the management of this institute for inviting us for this panel discussion. So, before that, I will quote Martin Luther King Jr. He said, "Intelligence plus character, that is the goal of education." Intelligence and education. Now, that is for any college. This is MBA college. And basically, we are going to talk about banking and finance. So, the MBA institutes teach basically business acumen and professional ethics. So, character, professional ethics, these two things are very critical if you are entering into the banking and financial sector. So, please remember these two things. From where you learn character and ethics, your parents, grandparents, tell you the story of Mahabharata and Ramayana. They are not a story. These are told to you so that you learn from the mistakes committed by the villainous character in these stories. So, before you jump into this banking and finance was on the railway track. You should have the ethics and character. You should learn what are the runs which can be done in the system. And I hope the institute have some training module or some classes on various crises which happened in the financial system and some courses on financial risk management. So during the 2 hours of our journey and this panel discussion, we will have to be listening to different terms like shadow banking, zombie trading, zombie lending, predatory lending, trade war, securitization. Then artificial intelligence, INDES, IBC, peer-to-peer lending, fintech. This goes on. These are the terms which will be bombarded to you when you come out of this prestigious institute and join the financial banking sector. I really appreciate the effort taken by this institute for bringing these panelists. You see the panelists, somebody is a principal of a training college, a renowned bank, somebody from the private banking sector, somebody from the technology sector, somebody from the shadow banking sector, and you have the professor, and I am from the regulator. So if you want to learn anything, if you want to take your first step, you should know you can take this step, whether somebody has taken this step in this direction or not, and what has happened if they have taken this step in that direction. For that reason, you should have the experience, you should have the knowledge of various crises which happened worldwide. So to start with the technology, before we think about our future, let us start to learn from the recent crisis. Why the recent crisis happened? The recent crisis happened because of some reasons. One of the major reasons is asking of high leverage to the banking system with high CRAR. I hope we know what is leverage and what is CRAR. How they are asking the high leverage. Banks are highly, we use a term, since you are not into the banking and financial system, we use a term, the banks are highly leveraged entity. Means their own money as a ratio to the borrowing outside liability is high as compared to their own money. So they play with outside money. That's why there are a lot of rules and regulations for the banking sector. The crisis started in 2007-8. It was because at some point of time, somebody decided to have some light touch regulation and supervision. It failed. That's why today there are high level of strict rules and regulation, and now people have started asking the same question: why so much strictness? When you ask this question, you should know this strictness we have adopted because we failed for the light touch supervision and regulation. So when there is high level of, when the leverage ratio is very high, and when I ask anybody your leverage ratio is very high, they come out to me and say, in my CRAR, there is a concept of capital to risk-weighted assets. It is very high. So how it has been shown as high? Because it can be shown as high if you have a very high capital or you have very low risk-weighted assets. You cannot have a high capital because to have high capital, you need to bring in capital. So what is the option available with you? The option is to reduce the risk-weighted assets. How you reduce the risk-weighted assets? You have to give loans. The assets are in the market. You cannot reduce the risk-weighted asset, but you can use various jugglery. One of them is securitization. I hope you understand the concept of securitization, where you put hundreds of lowly rated loans and you come out with 80s of highly rated loans. There is a big concept of all those concepts to be taught to you in the college. So through securitization, they have reduced the riskiness of the assets and they have shown a high CRAR. So what is the rule which have come out? You should have a simple securitization transaction now. If you have a higher complex securitization transaction, the regulator will put more of capital to that. The next part is use of subsidiaries. As a bank, my banker colleagues will definitely accept. There are a lot of rules and regulations for the bank because they are highly leveraged. But there is somebody sitting next to him, which is non-bank or shadow bank. There may be the rules and regulations may be too large. So there will be a tendency for a bank. There may be a tendency for a bank to have a shadow bank institute like NBFC, somebody through whom he can do some activity by surpassing the rules and regulations. Then there is a concept of too big to fail. Like, if I ask you whether you go to SBI, which is the largest bank, or to the smallest bank for any deposit or anything, you will say blindly you can go to SBI because nothing will happen to SBI, because if anything happens to SBI, nothing will left in the country. So regulator, government, everybody will take care of SBI. Now SBI here is a government bank, but if you talk about other countries, there are big private sector banks, and they have that thing. I am too big to fail. So if anything happens to me, the government will come to the rescue. So now, from the crisis we learned, the new regulations came as there should be more capital charge or capital allocation if you are too big to fail, because if you fail, it will be gone to the exchange. Then, can anyone tell me what is the biggest risk to the banking or financial sector? You must have, those who are from the finance background, you must be knowing there are various risks like credit risk, market risk, liquidity risk. Can anyone tell me which is the biggest risk to for the failure of any bank or financial institution? Anything? Everybody will say credit risk, market risk, and everybody was saying credit risk, market risk so long as this crisis didn't happen. This recent 2007-8 subprime crisis happened because of liquidity risk. All the risks correlated to liquidity risk. The problem was only one bank failed to repay its obligation. There was a liquidity mismatch. It could not match its liquidity problem. That's why the liquidity risks were there. And previous to this crisis, there was nothing called a liquidity risk, and there was no regulation for liquidity risk. With this, something came at liquidity coverage ratio, then net stable funding ratio, various ratios came into the picture. So I think you must be knowing about Basel. Basel 1, 2, 3. G20 countries globally. And one more thing, the panelists, there are two speakers who introduced these things. When I request the professor or coordinator next year, when they introduce, they should not start from India. You should not, if you are doing MBA, if you are going to the banking and financial sector, you should not start with India. You have to think globally. Because nothing in the banking and financial sector is in isolation. The crisis which happened in 2008, 9, 10 in US, it had impact on India from 2011, 12, 13, 14, and you are still there, and we are talking about the high level of NPAs. So when we discuss about banking and finance, we have to broaden our horizon. We have to read international journals. We have to what is happening in US, Europe, and Japan. So now recently, if we talk about US, there has been a rate cut in the corporate tax. So there will be an addition of 1.5 trillion of trillion US dollar deficit in the government exchequer. The Fed Reserve is shrinking its balance sheet. This will have impact on the Indian economy. When I say about zombie lending, can anyone tell me what is zombie lending? Because this happened in the US, this happened in Europe, this happened in Japan. If you don't know zombie lending, tomorrow you join a bank and you start all these practices. Can anyone tell me what is the steady-state approach in case of PCA? These are the issues which you should learn. Then, we have the issue of high NPAs. If I don't cover zombie lending, if the zombie lending and all these topics are not covered till the end, please ask the question, I will explain what are this concept. So this high level of NPA till 2013-14, there the high level NPA was not there. Suddenly, from 2015 to 16, it started. It started because the process started by RBI. What is that process? Can anyone tell me? Can anyone tell me? That's called AQR. What is AQR? Asset Quality Review. The Reserve Bank started the process of asset quality review, under which, if any account is a bad loan or NPA in one bank, it has to be examined in other banks also. Do you know what is CRIL? You must be knowing about CIBIL because you must be having credit cards and all those things. So you are CIBIL, but you should be aware of what is a public credit reporting system and what is a private credit reporting system. These are the things you should learn before you pass out next March. Otherwise, tomorrow these people will be on the other side of the table, they interview you, and they'll be asking you all these questions, what is this, what is this, what is this, and you will fail to secure your position in any of the great institutions. Under the AQR, you know what is IBC? You know what is PCA framework? I should not listen yes from the front row, because I presume the front row is reserved for the faculty and for the course coordinators. I want to listen the answer from the other side of the table. So when there are issues in the banking sector, the new technology, new thing you talk about fintech companies, you talk about, you know about what is ARC? You know what is P2P lending? These are the things you should learn. And the panel is going to discuss all these issues with this introduction back, with little introduction. I'll stop here, then I'll come back in between my question and answer. May I now request Mr. Manoranjan Sharma from Canara Bank, listen to him carefully, because he's a principal of a big bank. So, whatever doubt or anything, and I have great regard to him. I might not have great questions, but I have heard a lot about him. So, I am also eagerly waiting to listen to Mr. Sharma. So, Mr. Sharma, now the dais is yours. Thank you.
Good morning to all of you. Mr. Chairman of the session, my fellow panelists, friends, ladies and gentlemen. At the outset, I am thankful to the Great Lakes Institute for having me with you on this important subject. I have a structured presentation, but I'm afraid in the given time of 15 minutes, which the chair has been kind to give to me, may not be possible to run through the presentation. So I will skip the slides and leave the slides with you, maybe of some interest to the students, the faculty members. I would like to highlight some issues of considerable contemporary significance. Starting with the excellent presentation made in the morning by Shri Mohan, I'd like to highlight some issues. Some of you may be aware that at the moment we have a large number of important institutions, academically and otherwise, but perhaps one institution which has made a difference to the world, there are a large number of academically very eminent institutions, but perhaps Fermilab would always be there at the top. At any given time, you will have a large number of Nobel laureates working in the Fermilab in the US, and the greatest experiment being conducted all over the world, known in common men's parlance as the Watts particle, is being conducted there. So about 3 years back, the director of the Fermilab made a very important observation, similar to what Mohan also meant, that earlier the world's knowledge base doubled every 8 years. By 2020, that doubling time is to be slashed to about 76 days. This is the kind of change we are talking about. Everything seems to be in a state of volatility, in a state of change, in a state of critical ferment. If you look at the developments around you, you find that and a lot of important work has been done by an institution called WEF, World Economic Forum, and that has brought into sharp focus about the impact of the kind of sweeping digital changes we see all around us, velocity of change, its scope of change and systemic impact. It took telecom companies 20 years to reach 20 billion messages a day. WhatsApp reached 34 billion messages a day in less than 7 years. Going forward, WEF has identified and isolated 10 industries which are going to see disruptive changes on a large scale, and they have identified the banking and financial sector in the top 10. In fact, they have rated it as the number 4 industries. When we have this kind of a wide-ranging, not just incremental change, disruptive change, where do we go forward? I am reminded of a very famous 2 lines from a very famous English poet, T.S. Eliot. Where is the wisdom we have lost in knowledge? Where is the knowledge we have lost in information? So in all these maze of information explosion, the rise of the Internet of Things and other things, perhaps it is useful to have a sense of balance, a sense of perspective. India, we have 27 PSBs, 22 private sector banks, 44 foreign banks, 56 RRBs, about 1,600 cooperative banks. And bank credit has grown at about, as per the recent RBI data published in WSS Weekly Circular Supplement, has grown at about 12.64%. Credit offtake over the last 5 decades has been surging because of the strong economic growth, rising disposable income, increasing consumerism, and easier access to credit. As of Q3 of FY18, total credit surged to US $1288.1 billion. The digital payments revolution are likely to trigger massive changes in trade disbursement mechanism in India. Among other important changes, we have bank recapitalization plan by the government in India, which is expected to push trade growth to 15%. Banks are also making attempts to raise funds by QIP, but this has its own set of problems. Because when you look at the fundraising aspects, there are only 3-4 options. The first option, obviously, as a major stakeholder, Government of India continues to be the major stakeholder, well over 50%. In most cases, it is between 60 to 70%. So they have to give funds. But the government has repeatedly said that they will give funds only to an extent. They have other conflicting claims. They have fiscal deficit in rising, and the bank should put their own house in order. Other options is bank can generate their own funds by plowing back profits. But since banks are able to generate very little of net profits, this option is limited. Then the other option is going to the market, going to the capital market, but given the kind of state the banks are in at the moment, especially the commercial banks, public sector banking case, the chances are not very good that they will be able to raise substantial. Last 3 years, I think Pradhan mentioned about AQR, there have been other factors, asset quality review, directed by the then RBI Governor Dr. Manoranjan, September 15, concentration of NPAs in identified sectors such as iron, steel, mining, textiles, so many other things. And there are a variety of complex issues. Since this is a general issue, audience, let me clarify some issues. For example, the issue of infrastructure financing has evoked considerable debates and discussion across the development spectrum. Infrastructure sector, one major sector in which banks have been involved, is the power sector. If you look at the situation of the power plants in India, you will find that about 80% of the power plants are thermal based. In almost all cases, the government of India had given a guarantee to the banks and financial system that, and this was part of what we call the covenants, one of the terms and conditions, that the fuel linkage would be enshrined. And I don't wish to take a political stand, but because last 5, 6, 7 years, because of a variety of scams, scandal, a lot of them were discussed in the political forums, parliament, TV news, newspaper, 2G, 3G, 4G, all those things. Coal scandal, the fuel linkage could not be ensured. And because the fuel linkage, and as I said earlier, 80% of the power plants were thermal based, uninterrupted supply of coal could not happen for a variety of reasons. But then all the viability, the profitability of these power plants went for a toss. And in the factors, the large number of historic projects. There are no firm data, but on the basis of some kind of discussions with the Ministry of Finance officials, we are given to understand that something like 12 lakh crore of money is involved in installed projects, mainly in infrastructure and other sectors. RBI has taken some initiative. There are several schemes like Joint Lending Forum, 5 by 25 scheme, strategic debt restructuring. But all these schemes are now losing significance. We have some important changes like changes in the Sapience Act, IBC code, and reference to NCLT, National Company Law Tribunal. This has made some kind of an impact. Some cases, money started coming back to the banks and financial institutions. All this is good, but we have to see how far these can be upscaled. And there's another issue is that in certain cases, the money which is coming to the banking system is coming at a great discount. What is known in the language of risk management is banks are in some cases, I would not like to name those cases, but if you do Google search, you will get them immediately. That haircut being talked about is something to the extent of 80-85%. So that is not a haircut complete, a neck cut, body cut, everything. If banks are going to force to take a haircut of 80-85%, hardly anyone. So this is something like a work in progress. This is a welcome initiative, and then another good aspect is that India, at the moment, we have over 200 countries in the world. As per the IMF or the World Bank data set, we have 190, 195. Most countries across the world are following what is broadly known as the capitalistic framework. So here the Indian situation was very different from, let us say, a situation in the West or even a situation in the US, in the sense that here the promoter will take huge loans, avail the funds from the banking system, and gradually there will be some cases of siphoning of funds, some cases of diversion of funds, with the result that the company will go sick. But what will the promoter do? The promoter will float another company. So we had a unique situation which distinguished India from other countries was that the company became sick, the promoter never became sick. With the coming in of the stringent provisions of the IBC, so many other changes, now the promoters will no longer have a part in lines of the bankruptcy code, which is a very stringent in the USA. We have adopted, but this is something like, as I said, work in progress. We have to see how it works in the Indian conditions. These are welcome changes, and hopefully over a period of time, this will this augurs well for the Indian banking system. I will leave the structure to them. I'm just trying to highlight some issues so that maybe we can have greater connect with the audience. If you look at the position in the last 3 years, there has been a complete stagnation in banking credit. Again, now things have started looking up in the last 6 to 8 months in this financial year. Last year, April 16, we had a bank credit growth of something like 4.5, 4.6%, 4.7%, around close to 5%. Now, as an outsider, as a layman, this bank credit growth may not seem to be a very low figure to you. But in these days of risk management, we should not see things in a silo. Things should not be looked at in some kind of a vacuum, and they have to be placed in a proper historical and comparative perspective. And if you do these, look at these figures, 5% credit growth in a year by the banking sector. I'm talking the entire banking industry. What is given in the RBI terms are what they call a scheduled commercial bank, SCB, listed banks listed in the second schedule of the RBI Act 1934. This is the lowest credit growth in India's banking history in the possibly last 20-25 years. So this gives you some kind of a sense of the kind of stagnation. Now, of course, things are looking up, the economy is looking up, India continues to be identified as one bright spot in the global economy. Let me highlight some two issues on one issue on profitability, and then with that I think I will close, because last 3-4 years, the interest rate cycle, as students of banking and finance should know, every 5-6 years, we have an interest rate cycle. Either the interest rates keeps going down or it keeps going up. Last 6 years, we were in what is known as a downward interest rate cycle. And now the interest rate for last 6 to 8 months is now going up. The interest rate cycle has returned. So if you look at when banks are saddled with accumulated losses, banks are saddled with high-end pricing, mounting level of NPAs, they cannot generate adequate levels of income from the loans and advances. If you look at the asset side of the balance sheet, you will find that apart from the usual small items like cash, balances, bank, the two most important items are on the balance sheet of any bank would be loans and advances and investment, which is treasury operations. The last 3 years, for example, even if I have to illustrate from the example of my bank, let us say Canara Bank, we had 112, 113-year history. Till March 16, a period of over 110 years, we never posted loss in any quarter, in any accounting year. But March 16, because of AQR, concentration of NPAs, we posted a huge loss. But this gradually be seen as some kind of a one-off loss, and after one quarter, immediately after the end of the quarter, we were back in profits. But mainly, I will not go into details, I don't have it, but because of the contribution of the treasury income. By and large, treasury income is strongly and inversely correlated to the interest rate cycle which you have in the market. By and large, what happens is when you have a downward interest rate cycle, income from treasury goes up. Otherwise, once the interest rate cycle turns, you can also have losses on the investment portfolio, which is known as mark-to-market losses. Some of you may be aware that every 2 months the RBI governor comes out with a monetary and trade policy, and at the start of the policy, first few paragraphs, he identifies what is known as the stance of the monetary policy. For the first time after 3-4 years, I think in February 17 last year, if you look at it, you will find that the RBI governor made an important change when he changed the stance of the monetary policy from accommodative to neutral. To some of you, this may seem a change of language, a change of semantics, but those of you who are more interested in economics will know that this is a change of far-reaching significance, in the sense that this gives a clear message that in the perception of the Reserve Bank of India, which is also the banking regulator, is that from now on interest rates could go down, they could also go up. And that was the first clear indication. Subsequently, there have been 2 repo rate hikes and other things. So, but gradually, now things are looking up, but then loans and advances are also big. The Indian banking sector is passing through difficult, volatile, turbulent times. There are also some talks of mergers, consolidation in the banking sector. These things are likely to happen sooner rather than later. But I'm confident that given the kind of strength, the resilience of the banking sector in India, we are passing through difficult times, but we shall overcome. I'm reminded of a few lines of a very famous Hindi word, Dushyant. मेरा मकसद नहीं हंगामा खड़ा करना, मेरी कोशिश है ये तस्वीर बदलनी चाहिए. And given the fact that all of us are working in a coordinated and concerted manner, I'm confident that we will do much better in the days ahead. Thank you all.
Thank you, Mr. Sharma. So when you talk about the credit growth of 5 to 6% in this year, can anybody tell me what are the credit growth during 2008, 6 to 11, maybe 7 to 11, what are the credit growth? Can anyone have a guess? How much? We got 21%. When there why the credit growth is important? Because this credit growth is linked to the industrial output and industrial growth. So whereas 5 to 6% is very low, similarly 20 to 20%, 21% was also very high. And at that point of time, the term was there that was called the predatory lending. What is predatory lending? The borrower may not be of the requirement of any money, but you have excess liquidity and you want to grow, so you start lending. That is called predatory lending. There is another thing called predatory borrowing. That is another concept I will discuss. Now, that time the predatory lending. Now, when Sharma talks about the credit growth and all these things and accommodative thing, two stricter things, Governor coined a term that is called zombie lending. Zombie lending is when somebody is not doing well, but you continue lending. Zombie means dead person. Somebody is not doing well, but you continue lending with a hope they will revive. That happened in US, that happened in Europe, that happened in Japan. It failed miserably. Nobody revived. First, the company will not do well, the bank will lend, then the bank will be having less capital, then the government will come and they will capitalize the banks. That was the thing where the zombie lending used to. That's why after 2016-17, no zombie lending, no regulatory forbearance, no restructuring. The moment you restructure, you have to classify as NPA and NCLT. So now you have heard from the banking perspective, banking future, and let me assure you, while you may be having an NPA level very high, but it is not across the table. We have different types of banks. We have public sector banks, and under public sector banks, we have banks which are under PCA from currently asset framework. We have private sector banks, we have foreign banks. And there are other cooperative banks also, but we will talk about public, private, and foreign banks. My public sector banks may be not doing that way. Their NPA level may be at 10 to 11%, and the banks with PCA framework, their NPA level may be a little higher. But there are banks whose NPA level is below 1% also. What does that mean? That means there are some issues somewhere. But let us not feel very sad if the economy or banking sector is doing very well. Everybody is working very hard. All the banks, public sector bank, government, RBI, they are in coordination, trying to finalize various units so that we come out of this phase. And let me tell you, this is not India specific. We have not seen any closure of banks, public sector bank or anything during last 5-6 years post-crisis. But if you go to US, you already look at US. There are hundreds of banks which are closed because of the impact of the crisis. So we are still better off, and the banks are still trying to revive the things. With this, may I now request somebody from the private sector bank to speak about the scenario and the future.
So good afternoon, all of you. So I thought I'll wish you a good morning, but I'm just supposed to wish you good afternoon. Probably just a couple of minutes and good afternoon.
Sorry.
Fine. So this is the second time I'm coming here. Thanks, Great Lakes, for inviting me here, and more specifically, Professor Ahindra, Chakravarty, for inviting me here. It's always great to meet the students, and especially the budding students from the MBA colleges. They put a lot of questions to us, so I think we will be well prepared, well guarded for that. At the same time, I think it's very happy to be here, and panelists have actually put it up and said that what is there for the banking, what banking is changing. But more importantly, the banking is significantly changing, and technology is playing a very, very big role. And the technology is changing at a humongous pace that probably, I think, unless and until the banks are changing fast, there's always a threat from the non-banking finance companies or the fintechs coming and occupying the space of the banks. And also, what we have seen is the digital Darwinism is also coming into play. Probably the banks are not adopting to digital, the banks are not adopting to the technology. The customers would actually migrate to the new fintech companies. So what we have seen, probably the radio took about 100 years for adoption, or a television took about 50 years, and Facebook took about 3 years for adoption, about 50 million users. And Pokemon Go, how many days Pokemon Go? 19 days, I think. 19 days, I think. Pokemon Go to 50 million users. So tomorrow, if the product comes from any of the fintech or the non-banking finance companies, I don't think so. The adoption rate would be any years to come. It's only a few days. So for that, I think the banks are getting prepared. I think to a large extent, thankfully, banks like us and most of the Indian banks, but I think I can definitely wish for a bank. We are getting prepared well to face these challenges. And it's also important and relevant for you because if you're learning for today, you also need to understand the world is actually moved into day after tomorrow. So that's the kind of the kind of change of technology, pace of change of technology. So tomorrow, I think you also need to keep in mind, if I'm learning today, so what going to, I need to fix the problem for day after tomorrow, not for today and tomorrow. So I think stating that, let me also, for the sake of convenience, for the sake of better understanding, let me break up my part of discussion onto. First, let me go through the branch banking. Let me go how the branches are changing, what are the customer expectations, how banks are coping to meet the customer expectations. Second, I'll spend some time on talking about the small finance and the retail lending or SME lending part. And the third, I'll get into the corporate lending. But when I talk about the retail lending part, branches, when we talk about branches for the last so many years have been existing. And branches, when we talk about bank branches are always very expansive. So some of the best branches we go, there are about 3,000 square feet, 4,000 square feet, 5,000 square feet, spread over 2-3 floors. We had expansive branches. But gone are the days, I think branches, the branch design is undergoing a significant change. I think my regulator has actually directed us to quote, directed you and probably also message to us that whenever we are speaking about, let us also quote some global examples, we try to quote some global examples wherever relevant. So what we have seen in Europe especially, the branch banking has undergone a significant change. The branches are not these same old branches where about 2,000 square feet. Now they are actually becoming boutiques there. A 1,500 square feet branch with a couple of advisors, there are ATMs, there are a couple of advisors. The customers only come to take some advice from there. All other transactions are actually going on digital or in mobile. And if you come there, then there's also a children total lot. I think the children can play there, and there's a coffee vending machine to serve you coffee. And then the customers there get to the branch and then take the advice and then go out from the branch. For all the normal transactions, it's only the mobile or the digital channel that is happening. But very, very few transactions, only for the advisory services you come here. Similarly, in our Indian context also, especially for us, earlier we were opening about 2,500, 2,000 square feet branches. For the last 3 years, we have actually redesigned the branches and then said the branch size should not be more than 1,200 square feet for a metro. For a semi-urban area, it should be less than 800 square feet. It should be around 800 square feet. So what we also trying to do in these branches is we are trying to introduce the electronic lobbies. So in these lobbies, you find a recycler machine, which is earlier we were only talking of ATMs, which was only dispensing cash. Now we have a recycler which can accept cash from you 24/7 and also can dispense cash. So that's one of the great advantages. Any small trader, any customer can come and then deposit the money into the recyclers. Then we have a tab banking. So anytime you want and then do the transfers or do any transaction in the bank or know your balances, you can actually do it there. Then we have a passbook printer. Though, the large extent people have moved into the digital banking and electronic statement, but still a significant number of customers are there who want passbooks. Significant number, I would say. I think it would be allocated to be about 50% of the customers there who would like to have a passbook. So they would like to come and print their passbooks. And then there is probably three or four things which we are trying to help the check deposit kiosk. So you do not go to the teller or to any staff for depositing a check. You can actually deposit the check deposit kiosk and it automatically gets scanned and then gets processed in the back end. So these are the kind of advantages, these are the kind of technology upgradation that we are doing as a branches. Similarly, on the net banking side, tomorrow, earlier we used to call an RM to do your transaction or call a branch staff. Today what we have done is we have deployed a chatbot called as AHA. For example, for Axis Bank we are calling it as AHA. So what it does is, if you register for the bank for the first time, and then you call the chatbot, it actually does the transaction for you. It will tell you a balance, it will transfer statements for you. If you want to order for checkbook, it will order a checkbook for you. If you want something else from the bank, it will actually demonstrate. Similarly, we are also opening some remote banking centers where probably now we have Noida, Bombay, or Delhi, or and one more place we have Bangalore. So from there, the RMs, there's a remote RMs who call the customers and say that this is what the balance is lying in your account, you want to do financial instruments, or you want to do something else. So this is the kind of technology, this is the kind of client we are trying to build with the customers, so that more and more of these customers are actually getting served. Today, as the bank is growing, there is always a tendency to forget about the customers. The customer churn will always be higher if you not touch them. So this is one of the ways of building up the relationship. And more importantly, the bank is actually moving most of the things from the mobile. Today, Axis Bank Mobile, is one of the good mobile applications that we have got. Not only us, I think most of the banks are actually moving to mobile. And today, 72 functionalities are there in one single mobile app. It's literally that you need not come to the branch for any of your banking transactions. Apart from the advisory services that you want, you need not come to the branch for any of these transactions. So that's the kind of functionality that we are dealing with in mobile. So I think that's Jamie Dimon has said for JP Morgan Chase, he said mobile first, digital everything. So trying to move everything onto the mobile. It's probably a replication of our own behavior. How many times do we look at our mobile every day? About 250, 300 times. Or more than that. So if I'm looking at my mobile 250, 300 times, it's natural that all of you are our customers, all of you are having banking, or probably all of our banking customers are looking at the mobile so many times. If I don't put everything on the mobile, then it's going to be extremely difficult for us. And one of the classic examples, I think you probably belong to the generation Z. Most of you are generation Z here? Gen Y. Yeah. So probably people who most of you are there. So point is, about 55% of the people, or 51 to 50% of the people don't want to come to a bank to do any banking transaction. Is it the same of you? Yes. So that's the reason I think banks are also moving ahead. And then I think one of the classic examples what JP Morgan Chase has done, I think there are about 25 to 30 banks which are only on mobile, which are only digital. JP Morgan Chase has done, they have developed 3 different apps. One is Chase Mobile. For all the banking transactions, for all set of customers, they are going to have this mobile app. For only the people like you who don't want to come to your bank, they have developed what is called a Fin app. So you will not come to your bank. If you come to a bank, you will be charged. And probably you will not be given service. But all your banking requirements are taken care of with the Fin app. And the other is called as JP Morgan Chase Mobile, where all your investments for the wealth banking, wealth management, all your market movement, all those things will get captured in this particular mobile app. So this is the kind of, obviously you need, most of you may need an interface, some of you may not need an interface. But if you need an interface, then probably you walk to the branches. You don't need an interface, it's only the mobile app, which actually takes care of your entire banking requirements. That's the kind of technology that is coming to play, and then there are banks, there are fintech companies to serve all this. And banks are also partnering with fintechs to see that the technology is better. The technology is leveraged completely and then provided the best of the banking facilities so that it caters to each of the customer segments. And especially now geography context, when we look at it, when we are so going through technology driven, when we are so mobile, do we still need branches? Probably that's the dilemma that all of us have. But point remains that we need to have branches because the Indian branch banking, Indian banking is completely not evolved. It's on the cusp, I would say. It's on the cusp. And still, there are quite a good number of branches where the places, locations where the bank branches are not there. So we need to reach out those places, and even in the metro, semi-urban or senior citizens, they still want to come to a branch and then get the branch service. And what we've also seen is about 77% of the increment, 70 to 77% of the incremental deposits comes from the physical branches. So that's the reason what we always feel that the bank branches are required, and then we keep on expanding the branches. Europe, you have seen a lot of bank branches getting closed for a time. US, you have seen a lot of bank branches getting closed. Again, when it's talked about JP Morgan Chase, they say that they are going to open another 200 branches in the next 2 years' time. And rationalize the branch network that they have got, close some of the unprofitable branches, but they still say that we want to open 200 branches for the bank, because again, for them, about 70% of the business, incremental business deposits come from these bank branches. And the greatest advantage for India at this point of time is the Jam Trinity, which I call the Jan Dhan Aadhaar mobile Trinity. So Jan Dhan, we have got about 32 crore accounts got opened overall, including this, probably 100 billion bank accounts have got opened, are there in the system. There are more than a billion Aadhaar connections, and there are more than a billion mobile connections. This Jam Trinity, the data stack is working great for the country. And I'm sure as Nandan Nilekani has said, from a data poor nation, we have actually become a data rich nation now. And banks like us are actually using a lot of analytics. We have got huge analytics team in the bank, which actually mines the customer data and then probably proposes the right product for these customers. And depending on the customer segment, depending on the behavior, depending on financial status, we tend to give the right kind of products to the customer. So these are the various things which are happening on the technology front in the banking space. And obviously, you might have seen a lot of, all of you are customers of quite a good number of mobile wallets. Mobile wallets have significantly gone. I think the kind of transactions that significant growth in mobile wallets is also very encouraging. And the RBI is also has brought in some regulation, probably about in February, saying that some of the interoperability should be provided, KYC should be there, and the capital requirements have actually been slightly moved up. All these things have happened for the wallets, but I'm sure I think credit card, wallets, digital wallets is one of the major convenience for all the customers, especially for small. Most of the transactions are small unit transactions. And I think I was given to understand probably about 3 months back or 4 months back, we actually crossed 1 trillion transactions on the wallets. So, and the other important evolution that we had was on the UPI. UPI payment was so successful, I think it was about 1.1 million transactions over a couple of years back. Thanks to demonetization has helped significantly the digitalization of the banking industry from about 1.1 million to actually moved on to about 28 billion transactions. Very recently, RBI has launched the UPI 2, where significant amount of further enablements and processes are going to come onto the UPI, where it will further facilitate your Aadhaar transactions or invoice payments or some other repeated payments or recurring payments. All these things are going to come on your UPI. So I think technology is playing a big role in banking. Banking is getting adapted to the changing environment in keeping in mind the customer preferences and the changes of the technology, and also the different customer segments, and more importantly, the new generation of the Gen X or the Gen Y customers, and more importantly, we also need to be prepared for the generation Z which is going to come. Second, I think let me also talk on the retail lending part. So again, lending part, especially on the small lending part, is taking a big leaps and bounds of changes have happened. And just to tell you that today banks are in a position to lend you, providing the customer to the bank, you got a fast track record, banks are in a position to lend you in flat 20 seconds, less than 20 seconds. And today we are lending digital loans, personal loans, less than 7 seconds. The moment you get a pre-approved offer for a customer to the bank, in a mobile app, you get a pre-approved offer. The moment you say, I accept, in 7 seconds, in some of the cases, the loan can get disbursed in your account. You may ask me, sir, is there, don't take a DP note, probably most of you may not be aware what is a DP note. There are DP note, promissory note, or some other documentation that we used to take earlier. Now nothing, only your consent is taken, and then the loan is disbursed in less than 10 seconds. Similarly, I think the peer-to-peer lending, Mr. Pradhan has talked about peer-to-peer lending guidelines have come. It's again going to take big shape because some of the, China started a big way in peer-to-peer lending, but some of the fraudster companies have actually swindled a lot of customer money there. So I think the regulator is well guarded. So I think we are trying to evolve over a period of time on the peer-to-peer lending. And that's where I think over a period of time, I think it's also going to go significantly high. Similarly, on the small business loans, I think what we have also done is we have actually moved into digital. We do the digital processing for the customers, and if the customer of the bank again, whether it is not only a personal loan, not only the small loan, but again the business loans can be disbursed in less than a minute to the customer. So, all the background checks, civil checks, and other checks are actually done. The data is analyzed and some of the customers get pre-approved, and these actually the loans are disbursed. And fintech companies are also playing a great role in this. I think one of the global examples I will give you, there's a company called as MyBox in Luxembourg. And they launched one algorithm. They launched one platform called as for the small business lending. And where did they launch this? Not in Luxembourg, but they launched in South Africa. Because Luxembourg, most of them have a track record, most of them have a financial record, but they said we launched it in South Africa. And they launched in South Africa, where the credit records are poor, people are not having proper bank financial statements or records. Then what they have done is, they have put this algorithm and they said any customer who is interested should give access to his mobile phone. The moment they give access to the mobile phone, the algorithm will go and check his social footprint, his SMS, his messages that he has sent, and bank statements or bank messages are there. They check those data, and then if Chakrabarty, they sanction the loan in no time. And for the last 3 years or 4 years, the default rate is less than 7% there. So I think if you have a track record, you go to big lending, big financials are there, but even if you don't have a track record, there are financials that are going to come in play a big role in playing this. So obviously, I think the small finance is going to take a big shape, and in our country we have seen a lot of microfinance companies, NBFCs are coming in, fintechs are coming in who want to lend to this. People who don't have proper track record or great record, and then even short-term lendings are actually coming in this. Probably people want to fund you for a holiday, people want to fund you for a specific project, a specific requirement, and then you can repay them over a period of 3 months, 6 months. Apart from the period of the lending, these lending mechanisms are also coming. And the third part of the talk was on the corporate lending side. Corporate lending side earlier, as Reddy said, I think this review quality has actually given a big shocker to all the banks, and then probably about 11% of the, close to 12% of the advances have actually become the NPS in the industry after the S.S.K quality review has been done. And with the IBC coming in, I think it's a great platform for all the banks to resolve the issues. And earlier, these issues were getting unresolved and they were lying in court for indefinite long period of time. Now with the IBC coming in, I think it's a great boon for the banking industry. And the promoters are also very cautious that tomorrow if I don't pay the money, my asset will go, the management will go. And the greatest beneficiary of this is, I think, all the banks again. There's a credit, there's a database. Earlier, when we were doing the consortium banking or the multiple banking, if you're in the multiple banking, the other banks were not knowing what you were doing. When you were in the consortium banking, only the few set of the 10, 12 banks or 20 banks in the consortium used to know what the customer is doing. Now with the credit coming in, so we have access to all the data information of the customer, and then you can take very, very quality and informed decisions. Apart from that, the risk management is also moving on to, the technology is also helping on the risk management as well as on the compliance side. Today we have got at the back end huge applications which day to day on a daily basis, on an instant basis, run the transactions and simulate the data or puts you the picture where the credit transactions are happening or credit card transactions are happening globally. It will tell you within a minute saying that, for example, if I'm buying something in, today I've just bought something here and then my credit card transaction is happening in US. Suddenly they come back to me and say that, have you been to US? Your transactions are appearing on the US side. So whether it is a fraudulent transaction, then immediately you can go back to them and then tell them. So I think huge amount of soft technology is aiding in terms of addressing the risk. At the same time, compliance. So especially on the AML side, what we have seen through the demonetization earlier. So and on the foreign remittances, the technology is helping the banks big time in ensuring that compliance to the regulator, compliance to the law, various laws of the country. So all these are going to augur well for the banking system as a whole, and I'm sure I think technology in a way is going to play a big role in helping us serve the customers better. Just to quote an example that how JP is spending this. JP is spending about 9.6 billion rupees on technology, IT and technology. That's the IT and technology budget every year. 9.6 billion. Out of it, 600 million spent only on the fintech companies, on the innovation that are going to come in the banking every year. And there are 50,000 plus people working for the IT company, on the IT side. And there are 2,000 people who are working on the digital side. So anyone, and every year they intake about 1,000 people on. So if you've got any one of your interested, please post your resume on the JP Morgan side. And finally, to conclude, I think three important piece of suggestion or advice. I think as you get to step into your career, take care of. You need to be result-oriented completely. You need to look at whatever may be there, because your managers, your leaders, your everything. So you cannot come and tell us that, or tell your supervisor that my HR is not functioning, or my market is not functioning, marketing is not functioning, or my logistics is not taking me somewhere, or some other department is not helping you. But I think ultimately you are going to be measured by your results. So your result-oriented position should be much stronger. Should be stronger. Second is, I think you need to have the best of the attitude. Have the best of positive attitude in terms of great times, in terms of tough times. I think you need to have the best of the attitude. And third is, I think you need to maintain the highest standards of ethics and integrity. Without that, I think nothing works. Probably I'm not very sure whether I quoted, I think as Warren Buffett always says, if I recruit people, I look only for three things. One is the intelligence. First, I look for the intelligence. Second, I look for the energy. Third, I look for the ethics and integrity. And if the third is not there, I don't even look for the first and second. I think we've got umpteen number of examples like Nirav Modi or the Himalaya or somebody else falling like nine pins. The empire that they've developed for the last 25 years, 30 years, just crumble just like anything. So, and keep in mind that repetition is a very bad habit. Repetition comes on the hot, repetition comes on a footstep and has a bad habit of going back and comes back. Keep in mind that ethics and integrity plays a very vital role in shaping up and building up a career and sustaining a career for about 30 years of time. I'm sure all of you want to retire at 45, but in case if you want to have a career at 60, please, at all points of time, whether you do a career at 45 or 60, these things are very important. Thank you, and again, once again, thank you for being here.
Thank you. So, you are listening to a publisher bank or you are listening to a private sector bank. You will notice any difference. The public sector bank, as of now, because of the NPA problem, they are trying to come out of the NPA problem. Why? Because there are a lot of corporate loans in the public sector books, whereas in the private sector loans, they switched over to the retail loan at that point of time. So it is not that corporate book is bad or retail book is good, but you have to identify the timing when to switch from which book to which book. My private sector bank is thinking of more model of branch because it's going forward. But as a regulator or as government, the banks are linked to my economy, they're linked to my growth. I cannot think of no branch concept if I go 200 kilometers away from NCR. If I go 500 kilometers toward the eastern side of my country. So there, the public sector banks, they I have friends in both public sector and private sector banks. But when you ask any public sector banker, they will say, I have a branch where animals used to come to open the branches. Because you may not find a human being to open a branch after a time 10, 15 years back. It is very good to have no big product branch concept, but for that we need to develop economically to that level also. Private sector banks, they have the concept of 7 seconds to get a disbursement. But don't come to me, don't complain tomorrow to me. Me means RBI saying, I went to the bank, they say in 7 seconds you will give me the loan, but 7 months they are not giving me the loan. Have you heard the thing? He said 7 seconds for disbursement of a pre-approved loan. That means it has to be pre-approved. That means the appraisal they are doing beforehand. That means they are following all the banking rules, regulations. You may be faster, you may do all the things, you are in a race, you want to come fast, but you cannot change your track. You have to follow all the rules and regulations while adopting the technology. So when you are using the term technology, if I have a foreign bank here, you will not talk about loans and advances. Because he may be investment banker, you will talk only about investment. Now after 4 if I go, I have a person sitting over here, you will raise doubt in your mind whether it is bank or it is a technology. Because he is from the technology field. He has global experience. So let us listen to the person who will talk to you about fintech companies, who will talk to you about the use of technology. What do you know about fintech companies? In 1990, there are movie called Aliens. There are a lot of animal kind of things roaming around, so the people and everybody is fighting with them. That is the condition in India now. But toward the end of the movie, when the actual hero entered the room, there is a separate room. When you enter there, it was not 4, 5 or 10, there are hundreds of aliens sitting there. That is the scenario. You may not be finding many fine fintech companies as of now in India because of various rules, regulations, and the doors are closed, but the regulator or government cannot keep the door closed for a longer period of time. Tomorrow, these companies are said to come here, tomorrow they are said to spread over like anything, tomorrow they may have a dominant presence in the banking and finance sector. So if you, as he rightly said, when you are reading to what we are reading for today, actually the world is day after tomorrow. So if you want to join after in March, in another 6 months, after 1 year, what will happen you never know. So let us listen to the person who will talk to you about various fintech companies, technology, and everything. So may I request Mr. Biswanath Samir.
Thank you very much. I think the speaker before me has actually taken part of my session. Right. I believe topic is finance, right? Not banking. So I think 1, 2, 3 all concentrating on banking. So let me talk. Actually, before this session, I was accidentally cleaning my room and I was going through few things. One is my MBA finance book, written by Professor Kuchal. I don't know who's still alive or not today. He was from Ahindra in 1986. And accidentally I bought another book by Professor Prasanna Chandra from Bangalore. Same subjects. The whole book is different. Topic is financial management. Except for the cover, the book has changed. It's the world of disruption, you know. And let me talk about finance, not even banking. What is happening? What the disruptions are happening? I just asked a question. In India, which is the largest hospitality company in India today, having largest number of rooms, and which is the largest number of rooms in the world, Huh? OU and Airbnb. How many rooms they own? How many? Can I hear? This is the disruption. They are the largest number one in the industry of hotel without owning a single room. That is what is happening in the world. Even people could understand. Even Taj ITCs could understand what has happened. Agarwal has made his money, and what is his age? Huh? Louder. 24. He has done the job. So, let's talk of finance, and not concentrate into banking. What is happening in financials and what banks are trying to do, and what is happening in the financial space. Today, if you see, which are the 5 successful entrepreneurs in the world, in India. 5 successful companies. Which name comes to your mind? Flipkart. ATM. Then Ola. Then Oyo. Out of these 4, 3 owners are my friend. How much money they have taken from banks? How much? How much? Can I hear the answer? Yes, answer. 0. Where are the banks? The whole world of finance has changed from bank to venture capitalist. I have my startup in IIT. Moment I got my thing with all these things, Canara Bank lined up after me, SBI lined up after me, right, to give me loans. And I politely said, thank you, I don't want money from you. So the world of business and finance is changing. How startup India, whatever we are talking. So, if you look into the world of finance, it's a different. Ola, Make My Trip, whatever you say, the contribution of banking is 0. And they are the, even if you take globally, Airbnb, whatever you see. So the world of finance is actually changing, and no one studied the venture capitalist risk and other as a subject of finance. Is it taught in business schools? This is a reality, and business schools are behind. They will introduce in the course tomorrow or day after. Maybe your next group or someone will study, but the world has changed. So that is point number 1. Point number 2. Due to disruption, collapsing is happening, and they are forced. One collapsing happening. I was handling the stock exchange sector, and I have done my implementation in Bombay Stock Exchange and done the Delhi Stock Exchange. And I'm talking of year 90s. I think seniors can tell. There were how many stock exchanges in India? Every state has a stock exchange. Today there are how many stock exchanges? All gone. So it's the financing is collapsing. It's all into 2. Earlier, even what is happening in public sector bank, there is a lot of resentment, but what is happening? What is happening? What is happening in public sector banks? Merger, meaning collapsing. Why? Exactly. The disruption has failed, and now they are collapsing. It's not forward-looking. The mergers are happening. This is what the banking is happening today, not what is lending. Now, if you really, someone Google down what is in last 2 years, as I say, what is the lending percentage by NBFC and by the banks? Google, by the time I complete, you will get your answer and it will be astounding. Which is little known, have done the disruption. Banks are now to figure out what they are doing. right? And for your information, you'll Google and find NBFCs are taken over. By numbers, they are more than the banks. So this is what's happening in India. So it's all about disruption in finance, all about the way we are thinking the finances. During our times, regulators, I remember when I did my MBA, I had one paragraph on RBI. There is an element known as RBI, which does the regulation. That's all. Today, RBI is in news on daily basis, right? So the role of regulators have become very fast. They have to move. Today, every Tom, Dick and Harry knows RBI. I studied RBI as a history. Calcutta mein form kiya tha. It was SBI, then RBI. Those. Today, everyone knows what an RBI is doing. Even a layman can come and know what kind of regulation RBI is coming with. So the world of finance is actually changing. Earlier, during our times, we used to be fortunate if I know a banker as my friend. We used to take half-day leave to go to bank and take money out of it. And that banker friend will help me. To open an account, we used to run after the bank, buy an account hold it. Bank said no. Today, banks are after you to open an account. The whole concept of customer service. See, just by the explosion. Then let's take the Indian explosion, what has happened. Before 2000 and, again, while I say I'm not talking of any government, so don't take it politically. Because these days everything is read under the political this thing. Now really, if you see, before 2014, there were around 3 crores unique bank accounts. That's it. 3 crores. And the reason banks could not open the account is because people didn't have identity. The reason, and we hear about farmers' suicide, right? Everyone in the financial sector, this thing, every day newspaper, right? And you also hear that every state government is waiving off banks' loan, as if agricultural loan comes from free. Right? You agree with me with these two news? Yes, sir. Where is the fallacy? One side, bank and government is sitting with money to give loan and give a waiver. The another side, there are farmers committing suicide because they don't get money. There must be some gap somewhere. Both cannot be true, correct? There must be some gap somewhere. It is because, that's where the whole thing is, because the banking sector or the financial sector has limited its reach to the urban and semi-urbans. Whilst in India, I'll talk on Indian context and then I'll go global, while in India, the population is rural. So, how many of you have ever tried to get a student loan? क्या देना पड़ा? Someone, one person can narrate. Can one person stand up and narrate क्या देना पड़ा? One person क्या देना पड़ा? To get a loan, बोलो.
Sir,
you don't have to name the bank. Issue is not bank.
Personal ITR and then guarantors ITRs and bank statements, and some people might even ask for property and some might not ask for it, and many other things, identity and everything.
So banks are de-risking themselves before even giving the loans. So if this is the norm of a loan, Can it reach a poor people? Yes or no? Right? This is the problem of the financial system. This is where the whole finance regulator all have to address. And this is a big area where actually I'm talking of is fintech, which is the disruption. A bank has to go to every corner of India. And it is not possible for any bank to reach every corner of India. Not possible. And it is not possible for a farmer or a daily wage laborer to come to a bank 50 kilometers away, losing 500 rupees of his daily earning, paying 200 in bus to draw 1,000 rupees. So that is what he hasn't done. So it's an infeasible financial solution. And that is where the banking, in Indian banking stopped. What happened after 2014? What he corrected, Jan, is one of the major reasons which banks could not do it was identity. Today, through a digital identity system, everyone in India is having an identity, except for few people who does not want that identity because of certain policy, privacy issues like activists. Everyone has an identity. So your first question is answered. Identity you have got. The second part of it, now with an identity, banks through Jan Dhan is able to open up a bank account because bank is comfortable transferring money in bank account and not giving in cash. आपने कभी सुना है बैंक कैश से लोन लिया है? हाँ? So how will the farmer get a loan? उसके पास तो बैंक account है नहीं. So this is one change where these 3 crores actually have cost 35 crores in 2 years with Jan Dhan. And actually the banking system or the financial system was able to reach. Next is how within 2 years, no bank can make bank branches in villages and they reach in 2 years. Because every bank to move requires operations cost. Because bare minimum, you have to make a building, you have to have 3 people, you have to have 2 guards, you have to have a cash management system. With all this, you can open up a bank. So it costs. And all banks' pressure, thanks to this NPA, are all in red. How many of you follow bank's balance sheet? Which private bank is in white? Sorry, which public sector bank is in white? Huh? Huh? Which one? Loud. Vijaya Bank doesn't even figure in top 20 banks in India. So, all banks are in red. So, the moment your banks are in red, there will be an operations pressure. Right? It's normal. If an organization is red, it has to have an operation. So, your reach out has to go, and that's where the world of technology coming in. And like he said, you are interfacing not with the bank, you are not interfacing not with an people, you are actually interfacing with the technology. Did you understand? Your mobile, did you get the point that he was saying? Your bank is mobile. And then what? Another word he said, chat bot. What is a chat bot? Huh? There is no human, there is an AI engine running. So, when you see a chat, hi, I am Natasha, it's not no Natasha there, huh? It's a machine. So don't get confused with the Natasha and send different kinds of messages. Huh? Natasha will not respond. So it's a technology. So actually, your interface with the bank or the financial system is a technology. And then what happens? Today, what the financial, today banks are not banking. If you walk into a bank, like, I had an FD with my bank, which I kept it for the purpose and for the mandate. The bank manager slowly calls me and says, "Saab, ये FD में पैसा क्यों आप बर्बाद करते हो?" मैं बोला, "क्यों? ऐसा mutual fund." Did anyone of you hear the word mutual funds 15 years back? And the word debt mutual funds? So, and how they work? They are a financial system of its own. These mutual funds, debt mutual funds, financial instruments are taught in your curriculum? Yes. Huh? So, it was not there when I opened up 1986. Yeah? There was nothing like the word mutual fund. Today, I'm not talking of equity, that's a different part. I'm talking of debt, bond, and there is a new word known as financial engineering. How many of you have heard that word? No. And your Professor Chakravarty can take class, huh? He knows. Ask him one day to take classes on financial engineering. We had a lot of discussions with him on financial engineering. So, these are the concepts of finance which is taking over the traditional banking system. This is where it is coming in, and as you rightly said, that AI, ML, that is where banks are investing. So if you see banks have more technology company, even the loans, most of the NPAs, if you really see, are not, except for political thing, are not because they are NPAs because of any bank's fault. It is because the way business is done is changing. Suppose today I have to give a 1,000 crore loan to Infosys for a 25 years term. And anyone sitting in this room say whether Infosys will survive or not? I'm not talking of willful default. Can anyone in this room vouch and say there will be an Infosys 25 years hence? There was king known as Digital Equipment Corporation, vanished. If you really follow the stock exchange and the top 50 of BSE, you see last 20 years who are there and now who are there. It's changed. They are dead. Kodak is dead. Nokia is dead. So the companies which gave loans to Nokia could ever think Nokia will be dead. Microsoft will buy it and kill it. So the financial world is so dynamic, and that is where the technology, or that is what will drive the whole financial world. The fundamental concepts of banking will never change, because at the end of the day, it's a fundamental of economy. You require money to buy, you require money to sell. That's the fundamental of economy. But the way that economy is transacted today, the value of the economy, the way economy is moving will change. See the India's GDP 10 years back. It was an agriculture and followed by manufacturing. Who is driving India's GDP today? How much percentage? Huh? How? So the world has changed. So money flow has to be in the service. And most of the service industries are technology, and they are not taking money from the bank. And that is one of the challenges. A successful company, Flipkart, banks would have made a lot of money. Lending them is a business opportunity for the bank. Lost. Taken by Jack Ma's of the world. So players are different. Not talking of the banking, really. This is very interesting. The newer banks are different. Who is a bank now? Paytm. Anyone thought Paytm will be a bank? Airtel. Airtel to telecom tha. खोल दिया ना bank. Can anyone say Airtel will be the #1 bank in India 5 years from now? Anyone? It's a disruption. And who is driving this disruption? Technology. And the whole concept of finance is changing. It's no more of banking. My book of finance had only banking. Your books of finance will have banking, mutual funds, bonds. I don't know, VC and those areas are not introduced here, but those topics have been introduced already in the IIMs, I know, because that's the mainstay of the money now, and that's the mainstay of the economy. So that is where things are coming in, and it's all managed by the technology, and driving force is the technology and the disruption. That is the core. Where are the next level of disruptions which are going to happen in the bank or the banking or the financial system? One, there is two trends are happening. One trend which is happening to create a parallel financial system, and that's a debate, which is beyond the regulatory elements, because a section feels regulators are the problem. And that is the reason there are people in Supreme Court against government. So many people feel regulators are a problem. So go beyond regulators. And that is where the cryptos were born, not bounded by any regulators. And all the regulators, by the time, all the regulators were caught unaware, the Bitcoin has already crossed $15,000. Before people could understand what has happened, Ethereum came, Ripple came, it flooded the market. Some say it is Ponzi, some say it is non-Ponzi, so that is the debate. But the very fact is, non-regulated currency did take place. And today, regulators are reconciling how to regulate that currency and how to do this, because the regulators have a different challenge. The challenge is, it's no more a country. When you are in an internet zone, the country doesn't matter. Today, if India restricts me to do one thing, I had a challenge with Gulshan Rai. He is the country's regulator. And there was a time when Indian regulation actually stopped the pornographic sites in India. So I went to him and I said, sir, a smart class 10 boy can bypass you and do it. All I did, I went to a proxy site in Australia and from there happily opened up a site. I don't know whether he enjoyed that or not, but at least he saw. So, where is the regulation? And thereafter, I had a meeting with R.S. Sharma and these regulations were taken off. So, regulators are all in a fix of challenge because no one is, things are not beyond regulators. In Malaysia, which is known as the hub of crypto, Malaysian is a Islamic banking, which is very, very regulated. Islamic banking is very regulated, very different kind of a bank. So, everyone in Malaysia opened up an account in a South American country like Antigua, got an ATM card, which allows crypto as a bank account, had crypto bank account happily, and taking out the fiat currency from Malaysian ATM. With Malaysian regulator sitting, can't do anything. He cannot stop you from a bank in any country which is Visa, MasterCard labeled to take money in your country. And that is actually a crypto getting converted to fiat. So regulators are also in a fix. And now regulators have to come together to form a global regulation. And that's a different problem. Basel is coming in. And now, what the whole point is, the whole driving behind this is the change in the technology. That is making all this thing possible, and the mindset of the people changing from classical to innovation. People are not thinking of innovation. People are not thinking of disruption. So that thought process has synced in, and that's the reason you see Facebook which has come in. You see Google which has come in. IBMs of the world are losing. So that is the another thing which is happening in. And as I was discussing with him, he said he would like to term Axis as a technology company. Axis Bank as a technology company.
Let me correct it.
Yeah.
Banking is more of becoming a technology.
So technology specialists, banking today are recruiting more engineers. So that is what is happening. And to conclude, this is our technological evolution. The fintechs will take over. The VCs will take over. Those are the elements of finance and economy which is coming in. Global funding will take over. So that is where I think the finance has to take the impact of technology in finance and banking. Thank you.
Let me ask you a simple question. The professor of the class is worried of whom? The professor of the class is worried of which student? Tell me. Huh? Weakest. Next. Huh? Louder. The brightest. Then. Because of paucity of time, let me tell you, the professor is always afraid of the smartest one. The regulator is also always afraid of the smartest kid in the block, that the technology. But let me correct some of the facts. When you say the technology company or somebody, Paytm and all these things are coming in a big way, yes, they are coming in a big way, but till now, it is the Children Commercial Bank who are the biggest lender. Though their share has come down from 73% to 65% in the last 10 years, and NBFCs, all these technology companies and all these things are called NBFCs, their share has gone up from 10 to 18%. So there are a long way to go, and they will move. And they will travel the path. And when you say, for a loan, you need to give so many documents, with education loan or anything, let me differ with you. There are provisions for small ticket loans for farmers, and there are regulations and banks are following. They don't ask for any documents. And the loan ticket size is very small, and for that, there are financial institutes or small ticket size loans. Now, we have discussed about technology, we have discussed about fintech, we have discussed about public sector bank, we have discussed about private sector bank. Now, the major player which is repeatedly coming into this discussion, NBFC. What is NBFC? NBFC is non-banking financial company. Who is the regulator? Are they the only regulator? No. There are some NBFCs regulated by RBI, there are some NBFCs which are regulated by SEBI, there are NBFCs regulated by registered company, there are NBFCs registered by National Housing Bank. So there are various regulators which regulate the NBFCs. And one of the major players in the NBFC sector are the NBFCs which are regulated by RBI. And when you say the mutual funds and all these players are bigger players in the sector, yes, they are coming up very big, but as of now, you see, it is the banks who are the major player, which contribute to 46% of the total mutual lending. And the next is the AMC venture, the mutual funds, which contribute 15%. But why the NBFCs are important? The NBFCs are important because during the last 3-4 years, where the credit growth of the banking sector has gone down, where the NPA level of the banking sector has gone down, where the NPA level of the banking sector has gone up, where the CRAR of the banking sector has come down, in the NBFC, whose credit growth has increased, in the NBFC, whose CRR level is hovering around 20%, where the banks are finding it difficult to maintain CRAR of 15%, but the banks are having NPA at 11-12%, their NPA of NBFC has come down from 6 point something to 5 point something as a March 18. So that means there are certain things to be done from NBFC. But as a regulator, I am Do I have any concern for NBFC? Yes, I have concern. What are the concerns? When the credit growth is there in the NBFC sector, the equity infusion, the rate of increase in the equity is less than the rate of borrowings of this NBFC. When you say the NBFC are the lenders from where they are getting the money, there are two kinds. There are various NBFCs, but there are some deposit accepting NBFC, there are non-deposit accepting NBFC. The non-deposit, there are few deposit taking NBFCs which may be having 400 to 500 to total deposit, but their total portfolio size is very high. Should the regulator be concerned? Yes, because though they are not permitted to accept deposit, they have all the authority, all the license to borrow from the banks. NBFCs are critical from the supervisory angle because they are the lender in the financial system, which consists of all these things I told you, like the financial institution, asset management company, ERC, and all these things. So with this background, I have somebody from my, I belong to, as of now, I belong to the NBFC sector. I am in charge of the NBFC which are operating in NCR and Chandigarh. So one of my bigger NBFC is Fincorp. So I have the right person who can speak to you about NBFC and peer-to-peer companies. When we repeatedly tell it for your knowledge academy, peer-to-peer companies are basically NBFC. Previously, there are no regulations for peer-to-peer company. Anybody can have peer-to-peer company now, and has come out with regulation. If they have to be registered, they have to get themselves registered as NBFC RBI if they want to carry out peer-to-peer lending. Peer-to-peer lending is a very big concept. We will discuss some other time. Now, may I request Samir Mehta. Now, that's it.
Thanks, Mr. Pradhan, for introducing the non-bank. I thought we were discussing all so much about fintech, non-bank, and banks. I was wondering if people actually know what is the difference between a bank and a non-bank. So thanks for elaborating on various categories of non-banks and discussing. So I'm sure I would like to rather, we've had a great session and a great conversation since morning. Right from the sector bank to private to tech, and the change that is driving across. So there were diversity of opinion, I'm sure you all heard. But what was common across all was that there is a large disruption happening. Now, from your perspective, and I'm trying to connect, you are going to move out of the course probably in another 12 months. So how do you connect that with your career, your opportunities, what you should be focusing on today? I thought I'll probably talk more about that, taking you from what has already been discussed and what. So, regulator, just to step back, there are a lot of players in the space, in financial services space. As the regulator rightly said, there are banks, scheduled commercial banks, there are RRBs, there are cooperatives, there are NBFCs, there are now fintech players, there are payment banks, there are small finance banks. I think somewhere the regulator is very clearly evolving the concept that there are a lot of needs, varying needs in the sector, and I should create a platform for players to come and participate in that. So it's not really too much of overlap the way they want to drive it. They want to make it more complementary to these sectors so that there is banking available, banking products available to all sectors in the economy, keeping pace with what is happening in the world. So that's where the non-bank finance companies also come. So he touched upon the NBFCs which are regulated by the RBI, and technically they are called systematically important NBFCs, and we are one of those. And when I talk, I'm actually talking of those. Otherwise, there are almost 15,000, close to that number, of non-banks in the country. So we are not talking of the non-salient ones, we will talk about the salient ones which are likely to be your future employers, which are driving the change in this space. So they are typically, as he said, they are loan companies. So quite unlike a bank, where you have a lot of public liabilities on the balance sheet, which is your money, which comes as a saving account or a fixed deposit, to the other side of the balance sheet, which is the assets where we lend to you and you borrow loans. So non-banks, while they have the ability to borrow money in form of fixed deposits, but most of them actually refrain and stay away from that. There are a few which do. Primarily the business that non-banks drive is the loan business. And my focus is going to be on where the future of the loan business is going. We've all heard technology, and I, put some words on the table. We've all heard of big data, right?
Yes.
All of you? We've all heard of artificial intelligence.
Yes.
I was very glad to hear that you ran a course on AI out here. We've heard of blockchain contracts.
Yes.
We've heard of JAN today. Jan Dhan, Aadhaar, mobile. Right?
Yes.
Not many, right?
Yes.
We've heard of India Stack. Have any of you heard of India Stack? There's development happening. Something that I'll talk about. Software on cloud.
Yes.
Internet access and smartphone population in the country.
Yes.
Algorithms for everything in life. These are some of the trends which are happening across the day. These words are all trends that are happening across the world and driving the disruption and change. I was there in San Francisco attending one of the large lending events, global events. It's called Lending. It's the largest in the world. And there were 2,000 lending organizations over there. And we also have a rep in India and a couple of other fintech players, partners were there. I was so impressed and inspired because we had almost hundreds of people over there, your age coming and presenting ideas of how to harness all these technology points to solve for the problems. Now let me answer the next question. Typically, technology is always seen as an efficiency topic. That's how we've grown up, right? We've seen earlier we used to write, now we've got a computer to type. Earlier we used to send postal mails, now we've got emails. So these are things which are doing things differently, maybe more efficiently. But the way these technology trends are changing is they are trying to solve the same basic problems, but thinking differently. Let me give an example. Today, if Samir Mehta was to go to borrow a loan to any of the banks for a personal or an education loan, quite like all of you would have done, the first thing they will want to know is, do you have your identity documents with you? Right? So earlier it used to be a bank statement or some ration card or something else, then PAN number, slowly Aadhaar happened and now you have Aadhaar. Do I really need that document to come to me? Can I take your biometrics and can I conclude you are the right person who you say you are? Right? So that's one of the technology problem that technology is today solving. If you today go to a loan company, a bank, and say, I want a loan, they will ask you, have you taken a loan? Is there a bureau score for you? The answer is no, because you haven't taken any loan. So there is no bureau history for you. So how do I know that you are credit worthy of lending? Can I use technology to really get another way of solving for this problem? Can I look at your mobile data? Can I look at your maybe social media, maybe other metrics to use big data of how you behave in your life to draw a sense around you from a credit worthiness. So these are some of the problems which are being solved by technology. And technology for the sake of technology does not work. So if I was in your shoes, I would actually be focusing on understanding what do banks and non-banks actually do. They are raising capital and deploying capital more and more efficiently with each passing day, with each passing new version of technology. The core problems still the same. How do I underwrite? How do I deliver? How do I collect? How do I process? Whether you take fintechs, you take non-banks or banks, your education loan is not different. It's the same. Your personal loan is not different. Tomorrow, if Amazon were to come and say, I will give you personal loans, I mean, just for the sake of knowledge, how many of you will opt in for Amazon Finance? See? But the product that Amazon will give is the same loan. Why will you go to Amazon? Because it's the ease of delivery. It's the ease of engagement. It's the ability to get it when you need it. These are the aspects which are coming out of consumerism, are actually driving these trends. So I was talking to you about lending. Non-banks started as a small force in America. If you today look at the incremental through-the-door business in the banking and financial services space that's on the loan book side, you will find non-banks actually picking up lion's shares and beating banks over there. Now, one could argue and say it's because they've gone through a bad time and stuck somewhere and all those things. But it's the consumer preference which is driving this. Let me also take a step back and say there are various kinds of consumers. There are large corporates, there are MSMEs, and there are retail individuals like us, consumers. Where is this innovation visible right now? It's predominantly visible in the consumer space. It's predominantly becoming visible in the MSME lending space. Is it becoming visible in corporate banking space in a large manner? Yes, to some extent. As some of them they mentioned, they started using, the online models of contracts and stuff like that. So it started becoming visible. Is it as strong as it is in the consumer or small lending space? The answer is no. Is it directionally moving towards that? The answer is yes. So when you look back at all of these programs that you understand and study, which is AI, algorithms, big data, what you need to constantly keep in mind is how are these going to get deployed to solve for the big problems which are needed to deliver a product. And that's more important rather than getting caught with the fancy names of technologies. So those are my 2 bits about how you could leverage this. It's a very exciting space. The space is changing. I remember having heard people, so many young people, that I was actually thinking that, I spent 20 years, but these guys will teach me what banking is, in the space. And that's a fact of life. Tesla. How many of you have heard about Tesla earlier? How many of you have heard about Tesla coming in large commercial vehicles and delivering? And I'm sure you've seen all the WhatsApp videos, right? So the way it's revolutionizing the space, it's amazing. It's disruptive. To ignore it is not a wise thing. To harness it, to play along with it, to leverage it is the right approach. And I'm sure we have a very strong regulator. They are trying to do all that. But you all individuals in your capacities should focus on some of these new data trends, because these will become more and more important rather than the traditional banking learnings, traditional models. These are the way forward. You will see a lot of fintech players coming, a lot of non-banks, and even banks. Banks are not being left behind. They are very fast learners, they are quickly catching up, both private and public sector. So you will see a lot of opportunities arising for people who are fresh with ideas and application of technology like you. So thanks so much.
In the NBFC sector, recently we have given permission to one NBFC who says, I will not have any office, I will not have anything, everything will be this mobile. So they are going to come with this mobile only. Their office will be in a mobile also, their packaging will be a mobile, their appraisal system will be a mobile, everything will be mobile. So this is the era which is coming and you will be part of that. So the previous thing I asked, the professors are afraid of which kind of student. Now I am asking you, during the school days, you are fond of whom? During your schooling time, you are fond of which teacher? There are very few math teacher, English teacher, computer teacher, math teacher. You are fond of whom? No. Maybe like maths may be your liking subject, or most of the students, they are fond of their class teacher. Because other teachers come and go, the class teacher remains with them, they can share anything with the class teacher. So all the panel members who are like math teacher, English teacher, computer teacher, now comes your class teacher, Professor Chakravarty. So, may I request Professor Chakravarty, because he is a professor.
So good afternoon. It's an opportunity to speak on banking in the presence of the bankers. So the bankers must pardon me if things you do not like. Right? Okay, I start with the story. 2 months back, I wanted to buy a house. So I registered in the Magic Brick. When I registered in the Magic Brick, 2 banks approached to me. I have not even seen the house. So then I have seen the house, the bankers knew it. I never talked to them. So they approached and the agency comes and fills the forms and says, we'll give you the money if you require. I said, I don't need money. Somehow, I required some money. So when I told them, they said, we'll give you in 48 hours. Then this bank, which is a private sector bank, to whom I know, they said there are certain issues, we cannot give you money because you are overhead. So I went to a public sector bank and I asked them, will you give me money? They said, yes, we will give you the money, we will give the FD, we will give you the money. I said, how much will take time? They said, half an hour. So I said, can you release the money in 5 minutes, transfer by NEFT? They said, yes, it will take 25 minutes to release and 5 minutes to transfer. It's a public sector bank. Please keep in mind. And this person also offered me a cup of tea and brought some sweets from Home Sweets and said, you are really buying a house, so you must have Home Laddu. The point I'm trying to say is the technology is there, speed is there, but the Indian banks are changing very fast. And I am highly bullish on the Indian bank. I tell you why it is so. I spent, this is perhaps 40th year, I am teaching banking, training, worked as a banking consultant, spent 1.5 decades in Gujarat, Maharashtra in the fields of cooperative banking. So in India, the agricultural sector's problem is not because of commercial banks do not give money. There are other problems. This is not the forum to discuss that. But in 1936, the government formed a committee during the British period, All India Credit Survey, and we found that Maharashtra, Gujarat, Karnataka, Tamil Nadu, Andhra Pradesh, Bengal, all had a problem of getting agricultural loan. So when the public sector came, the concept Mrs. Gandhi took over in 1969, Mrs. Gandhi saw to it that as India is a rural country, in a sense 75% population stays there, money has to percolate down into the rural sector. So Mrs. Gandhi saw to it that the public sector banks must give to the extent of 40% of the time and demand deposits into the public sector, into the rural sector, especially in agriculture. This was a good effort by her. It was laudable. People liked Mrs. Gandhi's approach. A breakthrough into the Indian banking system, bringing out from the crony capitalism in those days, money was going on into the corporate. Unfortunately, the big babus of the finance ministries, led by the big ministers, big personalities, indulged into something known as loan mallow in this country and created a tradition of sanctioning money and not returning back. So the banks became red by 1991-92. Then as we went for the economic reforms, the Basel wanted India should adhere to Basel norms. Indian banks, a quick larder of the system, took into the Basel system, and then for the time being, it has a bad period because provisioning norm was very, very strict. The banking regulator, Reserve Bank, ensured that the banks follow the rules given by the recommendations of the Narasimham Committee, and banks did extremely good job. Our area chairperson finance, Dr. Preeti Goyal, is sitting here. We have prepared a paper on the banks, how it drove the India's growth in this country. And we did an excellent job. If you look at the last 25 years data, credit mark goes to Mr. Pradhan. You said 11% NPA. This is the document I have which shows 11% NPA in some banks. So the point here is, we have seen Indian banks have given sanctioned money to the industry group. In a long journey of the financial trajectory, in India we had post-independence IFCI, IDBI, ICICI, those who used to give money for the industry. Indian industry, what you see today, is the outcome of those industrial sanctions. Post 1991-92, the difference between the term lending institution IFCI, IDBI, and ICICI got blurred, and they virtually lost the battle because the cost of raising funds was much more, and the lending which they were doing which subsidized the technical entrepreneur, backward area development, the economics were not working. The first was to dwindle was ICICI. So a reverse merger took place. ICICI Bank took over the ICICI Development Bank. Mr. Kamath was brought in from Singapore. He was teaching there in Asian Development Bank, and he was given the responsibility to run the ICICI Bank. The second was IDBI. IDBI Bank was associated with that. Third is now having breathlessness is IFCI. You see there the news everywhere. So some banks will close, some industry will close. In US, 11,000 banks were closed at one point of time. Why it happened? Because it's all learning. In India today, you don't see anything except LG and Samsung. Where gone the industries? Uptron, Beltron, Keltron, Onida. Nobody discusses about them. This is the part of the economic growth. There will be some failure, some backup, but Indian banks are doing well. There are certain challenges. The challenges are, one is, there are certain macro policies by the government which is affecting the bank. So because of that, I give an example. A mention was made by Dr. Sharma. Look at the power sector. We developed a policy that infrastructure will fund. So 2006, in the month of May, Dr. Montek Singh Ahluwalia presented a paper in the Planning Commission that India requires funding for the infrastructure sector, and power is a sector where you have a huge investment required. The paper came out. Industry, private sector wanted to spend or invest money into the power sector. Then what happens? The banking sector was encouraged to finance power sector. There's a problem, as Dr. Sharma mentioned, there's a problem of coal linkage. We have not given the coal linkage. Some companies were allowed to go to bring coal from outside. Now here, the students of management, those who are studying finance, the point has to be kept in mind. In power, a tariff, when it's calculated, a return on equity is given 15.5% built into that before the project starts. Imagine the effect. The interest burden today is 9.5 to 10.5 at the most, or sometimes it is 8.5 to 9.5. But you are allowing power generating sector to give a return on equity of 15.5%. Now, this is the cost of generation which comes around 3 rupees 75 to 3 rupees 80 paisa. You take another, we have a power expert sitting here in our 1 year program in section B, I presume. So another 80 paisa for transmission, another 1 rupee 70 paisa. The cost of power works out to be 5 rupees 60 paisa on an average. And you are selling that power of 4 rupees 60 paisa. The banks have been told to finance them. Banks have indiscriminately financed them. 8 lakh crore is the portfolio of the banks in the power sector. And then the problem comes, power doesn't sell. Company cannot repay. The banks suffer. This is what is in economic survey you will study, known as twin balance sheet problem. Twin balance sheet problem means you have given money to the companies, and the company has taken the money. Company cannot pay the money, so company is sick, bank is sick. Twin balance sheet problem. This is what Mr. Arvind Subramaniam, Dr. Arvind Subramaniam wrote in Economic Times, finally lost the job because government did not want this to be written. So this is, the bank were not to be made scapegoat for all sorts of discussion of doing bad things. Extremely good things have been done, but you look at the legal system in this country. Anybody takes loan can get away with it. It can go on 15, 20 years. You cannot recover money. The assets cannot be confiscated. You cannot liquidate the assets. So thereby the legal system, government's policy is affecting the institutions. After all, it's a place where people come to work with professional competence. They have been trained to do lending. They are supposed to do the lending, which they do well. Today, the whole media made a juicy story about Mr. Malla and about Nirav Modi. And the chairmen have made the scapegoat. But the process was done. SBI was the lead institution in case of Malla. When the loan was given in 2005-06, whole world's report you scan, go to the Google and find out the airlines growth study in the 2004-05, what it talks about. It says that China and India will drive the growth of the airlines industry. This is the industry where maximum number of industry and maximum number of companies opened and closed. This is 95 to 2005, maximum number. Industries were suffering from that. So banks financed them and lost them. It is the management failure of the enterprise which has made some of the bank's portfolio sick. But what I see today is that the plus points in the bank is something like this. Banks have become customer savvy. The new generation of employees recruited at the bank, the training given to the bank, all the banks have a learning and development system. Young students with the good marks are entry point very thoroughly examined, and they are delivering results. As I said, in bank, public sector bank, they attend to us, they talk to us, things happen that way. Now the question arises, what will happen to these banks in the coming days? There's a question come that whether banks will survive. Very jolly will survive. You look at Kotak Mahindra Bank in the private sector, took over ING Vaishya. When it took over ING Vaishya, over a period of time, the company's share prices become double. because ING was so messed up there. ING messed up there in Europe. So they had to sell this. Kotak was looking for a growth in southern India. The moment it takes over, there's a 600 branches added to Kotak Mahindra. So Kotak Mahindra business grew. So what I would suggest is that study the bank's balance sheet, as Mr. Sengupta says. Look at the bank balance sheet, and you will see that the enormous growth taken place. The whole Indian industry is surviving today because of the bank. Though there are certain unsavory features. We have a maximum number of economists sitting here, but still 1 or 2 points. GDP of this country is what? 150 lakh crores. So the 30% saving, you have a 45 lakh crores. With the ICOR of 4, we get God-given 8.5% incremental GDP. But we do not get that much incremental saving into the banking. It goes to different places. You have already heard, mutual fund is taking around 25, 26 lakhs crore is the portfolio. Thereby, funds are moving to other areas and not entering into banking system. So banks will have to go for deposit mobilization. Again, the macro policy is interest rate falling. So deposits are coming less. So money goes somewhere else. So thereby, this needs to be taken by the government. And the last point here is bank has fortunately come out of the political intervention in a big way. Banks are now much more professional. What is happening in this context in the world? Nidhi is sitting here, Nidhi Saini, who is the interlink between the great lakes and the corporates. She requested me to write something on the Chinese banking. So I studied Chinese banking well. And I found that the NPA in Chinese banks during the period of 80 to 2000 was a hopping 40%. But why China did that allow? Because China's only issue was push money to industry, produce goods at a cheaper price, don't pay the money back to the institution, just export and build up surplus. China got ready in 20 years, 78 to 98. Then 2005-06, they thought that now we have built our competency in production, we'll go to the WTO now. They have reached to that level from 2005-06 to 2015-16. They have built up the muscle in terms of competence and quality. Now they are fighting with the US. So when India is thinking on that line, we have reformed our economy in the 90s only, and 90s to 2018. It's a 25-year journey. It's a great journey. We have done extremely well. Today, our investments, our industry is respected globally. 1, 2 hitches here and there cannot make a sector bad. So the banks will rise and will rise and will rise. Thank you very much.
Thank you, Professor. Now, because of paucity of time, we'll just straightforward take questions from you. If you have any question you can ask, the panel will answer depending on the questions. So questions, please.
Good afternoon, one and all. Previously, when I was reading an article once, ex-SBI head Adunati Bhattacharya said that the way to go ahead is not to just reimbursement loans which government does always. It's not good for banking system. And it was also opposed in the media. Why it is, why did she make that statement?
Waiving of the loan, you are talking about waiving of the loan?
Yeah, she said it's not good for economy. The government always does it, but it's not good for the economy. Why did she make that statement and what is the result?
So who will answer?
Any bankers can.
Any bank.
It's a banking issue. Bankers issue.
Let me tell you, the panel is there. I am outside, I am the moderator. If nobody takes the responsibility to answer, I will answer.
Okay, in the banking sector, this is the second major loan waiver. First time I think we had sometime in '92 or so. By and large, the bankers are agreed that the banking system takes a hit. The repayment ethics are damaged. The recovery climate is vitiated, and this has a by and large well demonstrated in banking literature. You have reports on currency and finance by the Reserve Bank of India, trends of progress in banking, work done by the Government of India in terms of the Economic Survey of India. You have a large number of anecdotal evidence, empirical evidence. That is one side of the story. The other side of the story is that the Indian agriculture continues to be in a bad way. If you look at the position historically in a comparative perspective, you will find that agriculture accounted for something like 50% of India's GDP in 1950, which shrunk to something like 16% in 2016, 17, 18. This is one side of the story, as a Hindi picture says, Shah Rukh Khan ka dialogue hai, picture abhi baki hai mere dost. And the other side of the picture is very damaging, in the sense that while the contribution of agriculture to GDP has shrunk drastically, the percentage, the proportion of people engaged in agriculture continue to hover around the same level. It used to be 65%, now it is close to 58%. With the result that relative disparity has increased. Over the years, there have been numerous studies by Agriculture Prices Commission, so many other sections, that the farmers are not getting a remunerative prices. This is reflected in large number of deaths of farmers living in conditions of utter poverty, destitution. So recently, this is one of the major reasons behind the present government's policy pronouncement, where you say that the farmer should be given 150% of their input cost. But there are several measures to it. But whether some relief has to be provided to farmers at the macro level, but whether the banking sector, there is considerable debate, and that's an open question that a political decision has to be taken. Now, most governments have taken a political decision, but as far as the banking sector, it hurts the banking sector by vitiating the recovery climate. I would not like to go beyond that.
Let me just add to it. As RBI, I'll speak on behalf of the banks also, because somebody asked the governor of RBI, there is always a fight between government and RBI. So who is correct? So the governor, my ex-governor, I really told, government is the fiscal authority and RBI is the monetary authority. Okay? Government is trying to save the economy from RBI, and RBI is trying to save the economy from government. The intention of both organizations is to see the economy doing well. Now coming back to your question, when you say why Arundhati Bhattacharya say this is bad, let me answer to you as a banker, as a regulator. Another question was asked to Arundhati Bhattacharya in a conclave in RBI, why the repayment and why the CD ratio is very low in the eastern side of the eastern part of the country. Though Arundhati Bhattacharya is from West Bengal, what she say? Because the credit culture in the eastern part of the country is very poor. What does that mean? Means people feel they will take a loan and they will not repay because tomorrow government is going to waive the loan. Now suppose this is a group of people who had that feeling, and this is a group of people who has repaid. Both of you have taken 100 loan. You have repaid and you have not repaid, and government came back and waived all your loans. So what was their fault? This is going to spoil the credit culture. Means you take the loan and you feel I don't require to repay. So next year, both of you again take the loan. So these people also will default. That is the concept. Why she say whoever is not bad, whoever is good for a particular section of the society, because the farmers have problem, we are waiving it, but now it is creating a problem to the banking sector because the credit culture is going down. Okay, that is the reason why she said whoever should not be there, because next year they will not.
Okay, so thank you for all these interesting discussions that we had. And I think a lot has been said in terms of how, all these institutions are using tools to make it easier for the end user experience. I think that's the final intent. That's what the relevance lies. I have a question which is more related to a banking experience as a consumer or a end user. Now, every bank, or most of the banks, I suppose, would have something called a custody ID, which is supposed to be the tag by which you can identify everyone. That's the normal process. And with all these AI and ML and things like that, a consumer is not supposed to do the same thing repeatedly. But you walk into any branch of any bank, you'd have a KIC for your banking account, you have a KIC for your credit account, you have a KIC for your loan account, the loan center is a different entity. You are the same customer ID, and why are you repeating it again? So what's the use of all these tech infrastructure, and at the experience level, you're not being able to deliver?
I think absolutely valid. I think as a consumer, the customer faces problems when you give it for a credit card. When you have savings account, when you go for a credit card, again the entire set of KYC documents have to be given. When you go for a housing loan, the personal loan, this set of documents have to be given. So what the government is also taking steps for the central KYC registry. So it's not completely taken off. So it's in the process. And within our bank also, we are implementing the system of what is called the central KYC registry. So you give one set of documents in one place. So all the other relationships with the bank, you have with the bank, those will be covered. Probably I would only say that it's some time away, but we are in the right direction.
I just want to add here. See, the question which you raised, actually it's a global. Banks are spending, I would say, in billions to actually solve this problem, to have a single view of the customer. So, and India is no exception.
No, let me add to it. When you talk about uniform customer ID and everything, you go to any bank, nobody is able to as of now implement it 100%. Because technology has come during the last 10 to 15 years. To ask my Canara Bank people, they have customer for the last 30 years, 40 years. There are some data which are old data. And the biggest bank, SBI, is trying a lot. They have Operation Ganga to clean up the data. Because when they switch over from the manual thing to the technology platform, at that point of time, they have entered so many data and people are in wrong data also. So it is going to definitely take some time, and as he rightly said it in our previous speech, everyone faces a problem. The moment the data is perfect, after that you may have necessary. It was supposed to be last question, but from the panel side, we will take the last question because otherwise you will skip your lunch.
Good afternoon, panel. Thank you for such an informative session. Sir, my question is to you.
Yeah.
So, going with today's theme of rethinking the Indian banking industry and design, business design, you talked about the 5 companies, and then you asked that from where did they get money. So, you said that none of them got money from the bank. All of them are getting money from venture capitalists. So, if we talk about redesigning and thinking, why can't they take money from the bank? Why do they don't do it? What are the barriers? And how can bank overcome this? And what can be the new collaborations that can come in for companies and startups, because this is a startup journey?
I mean, this is a big question, very good question. And in fact, this is an MBA question of an examination paper. See, if you see anything, any bank money is a debt. So, whether your business works or not, debt you have taken, and you have obligation to repay that debt. Why else the VC money comes in form of equity? So, if it's a high risk, so if your business grows, you will get 10x return, but the reverse is also true. So that is the reason this equity venture, this system is much more better way of taking money because actually you're increasing your capital. And more you increase the capital, your company valuation rises. And rigorous study, the more you take debt, the company valuation grows.
That is
so valuation diminishes. So it is easy to take equity. Moreover, it is seen that the venture is a very important point, and this is my experience over last, I would say, 7 years in this case. Moreover, the venture capitalist does a much better due diligence. They have that infrastructure than the banking system. Because banking are de-risking themselves from collateralization. They will never evaluate you on business and other things. Whether your business runs or not, they want their money. But if VC gives you money, you have doubly assured that your process, your team, your competence of success is high. Thank you.
Now let me add to it.
Yeah, even I wanted to add to it.
And I also want to say that whatever he explained is the traditional thing that is going on. That is those are the reasons. But my question was on lines of what can be done to improve this and get into it by the banks.
That's why I'm coming.
So many banks today are parking the fund. SBI is doing it. If you really see, SBI has formed a startup capital. So many banks today are getting into that space in limited way, but they are, like RBI is standing there. They are guided by the RBI, yeah?
No, that's why I want to say, there is a concept called RR. You know RR? Risk adjusted return on capital. Venture capital, it's their own money, whatever they want to do, they can do it. But in case of bank, they have to follow the risk adjusted return on capital model because they are highly leveraged entity and they are with public money. So the banks should have equipped themselves, they should have a loan policy to finance any new innovative technology. They should have a system to appraise that thing. Now we are coming out with a new technology. If the bank is not confident about that thing and the bank doesn't have that technology to analyze your thing, bank will never give you a loan. But as it is risk adjusted returns, so the venture capital, they take more risk and they get more return, and sometimes, as you rightly said, they may not get return also. So you are always listening and you are always talking about all the stories which are success stories. But when there is one success story, there are 99 companies which have failed. But it depends who has to take that risk. That is the reason why banks are not taking that.
Yeah, so these are two different asset classes. There is a loan and there is an investment. Typically the lending in India has been traditionally to people who are prone credits. You look at all the institutions in the banking sector or non-bank or others. Traditionally, they will want to lend to players who have certain vintage-driven conduct, exhibited performance, and then they want to come and do a loan. Why? Because loan is lent at a fixed rate. There is no variable high yield loan concept or kicker available to increase. So venture is typically coming in the space. So venture debt or venture capital per se, both are coming in the space when it's an early stage startup. Our private equity is coming at a series A, B, C after that, when it's starting to take shape. There is an opportunity, but the institutions in India today who being run traditionally do not really have the ability, number one. Number two, they've not made a choice of getting into that space because of some of the consideration that is the case. Third is, at the end of the day, someone will come in and fill the space. Someone will come in and fill the space. For example, for the smaller players like MSMEs who are budding exporters, some of these programs are flourishing and doing well even in public sector banks. Some of the non-banks like us are also doing it, and we are participating. Obviously, these are high return, high yield kind of structures that we do. But people are slowly moving into that space to be able to target this opportunity, which has happened as a result of lot of startups in India. Earlier, to start a new company used to be a hassle. It was a big thing. Now you see a lot of budding entrepreneurs coming straight out of IITs, starting the firms. It's become easy to do business. And therefore now financing options also will follow. soup in that sense. It's a matter of time that large organizations with large character and history and inertia, how soon they can move. It's a matter of time.
Sure. So I think the panel has done a great job.